The main topic I want to address tonight is the lessons of this crisis for longer-term economic policy, and in particular, for financial regulation. There are some who suggest that our recent crisis calls into question the basic premises of American capitalism as an institution. I reject this view. Mine is closer to that of Keynes, who in 1931 famously analogized the Great Depression to a magneto problem. Magneto was British English for the alternator of a car. When it shorts out, the car does not move. But it does not mean that the car needs to be discarded, rather that the faulty component needs to be fixed. Nothing that has happened calls into question the faith that properly regulated markets, freedom, and the application of science and technology together offer the most reliable route to betterment. Equally, though, I reject the view expressed by some in the financial sector that financial crises are an inherent part of economic life that one has to simply accept and plan for. The view that there are things that happen every 5 to 7 years, and it's just the way it is, just as hurricanes happen occasionally. It is said that John Kennedy took arms control far more seriously as a central issue after the Cuban Missile Crisis. Equally, after the events of the last 2 years, we need to rethink domestically and globally a system of financial regulation that has proved manifestly inadequate. Think about it. During the last generation, the world has seen the Latin American debt crisis, the 1987 stock market crash, the S&L debacle, the Mexican financial crisis, the Asian financial crisis, Russia LTCM and their aftermath, the bursting of the dot-com bubble, Enron, and now the financial crisis that began in 2007. If you add it up, once every 3 years, a financial system that is supposed to have as its central function the distribution, management, and allocation of risk has instead proved to be a source of risk that has threatened, if not wrenched, the jobs and livelihoods of hundreds of thousands, if not millions of people who, when they hear the initials AAA, think first of an automobile club and not a bond. Not only has our financial system failed to well serve our economy, has not even well served those who have invested in our major financial companies. An investor who invested in a diversified portfolio of major financial firms a decade ago would not only have done badly, but would have significantly underperformed a stock market that has suffered through its worst decade since the Second World War. All of this suggests a compelling case for thinking very carefully about the future of financial regulation. Several observations, I think, help to frame the discussion. In some areas, airline pricing, for example, there's an entirely legitimate debate not about how to regulate, but about whether to regulate. This cannot be the focus when we're discussing the financial sector. Imperfect information is ubiquitous. There are large externalities to major firms' actions, and there will always be doubts about even stated government commitments not to intervene. There's every reason to believe that pure market solutions are not viable. What should be the objective of the financial system, or more precisely, financial regulation? Jim Tobin famously observed that it takes a heap of Harburger triangles to fill an oaken gap, by which he meant that the microeconomic inefficiencies associated with tax distortions are likely to be small compared to the output costs associated with recessions and depressions. Seems to me equally that, as Ken Arrow once suggested to me, it's important to remember as we approach the financial system that marginal improvements in the allocation of capital are likely to be far less important than reducing the risks of major crises and panics. It's important also to remember, as Gary Becker and many others in many places, including perhaps prominently at the University of Chicago, has pointed out, that problems of misaligned incentives are not confined to the private sector, that public as well as private actors face crucial incentive issues. In finance, as in many areas, but I think the phenomenon is particularly pronounced in finance, there is the very profound difficulty that those who know the most about it are the least likely to be disinterested. And there is the reality that the financial services industry this year is spending $1 million per member of Congress lobbying the Congress. For each member of the Congress, there are 4 lobbyists working on financial service issue. This point has been brought home very powerfully in the area that John Thompson mentioned in introducing me. The most expensive failures in American financial history, those of the government-sponsored enterprises, can be traced to a particularly toxic combination of implicit government guarantee and excessive political involvement in rule setting and regulation. This suggests that as we think about regulatory approaches, we place a premium on the use of rules rather than discretion, that we emphasize the importance of transparency, and that we use market mechanisms wherever possible.